Good day, everyone, and welcome to the UTI Fixed Income Call. We'll be discussing the main trends which took place in the month of November and an outlook on how the fixed income markets are likely to be going ahead and the products which make sense in the current market construct. So we'll start with the global trends to see how things have shaped out and their effects on India. So if you look at the global economic activity, it continues to remain soft. If you look at on the left-hand side of the slide, which reflects JP Morgan manufacturing as well as services PMI, and if you can see the manufacturing slowdown, which largely started somewhere in the middle of 2022, and it's been a consistent downtrend since then. We saw some shifting of spending from manufacturing into services in the late 2022 and early 23, but that's also starting now to fade out. Of course, it's right now in expansion. Anything more than 50 is expansion. But if we look at the degree of expansion, that's also started to slow down. So, but broadly, it means is the benefits of excess consumer savings which we saw in the post-COVID period, that is now being spent down. The savings level is getting lower. If you look at even the job market or the labor market, that's also starting to slow down. And hence we see this softness in both manufacturing and services. That's also continues to reflect in the global trade and output volumes, which continues to go or trend below the trends we saw in 2021 and 2022. If we look at the commodity and the food index as well, because that has an important bearing on global as well as domestic inflation, despite the supply side shocks. I mean, this year we had major geopolitical escalations. I mean, the Russia-Ukraine war continues to remain high intensity. In October, we also had tensions between Middle East. And of course, we have had various weather-related disruptions all over the world as well. But if we look at the commodity index, that continues to be range-bound. So if you look at since Jan 23 and to this date, it's largely been in the range of 100 to 105 almost, because the end-use demand, especially led by China, has been quite weak. So, and if we look at the food price index as well, which is on the right-hand side, that also continues to be lower. So, given that we are still yet to reach an inflection point as far as commodities is concerned, the market is largely taking its cues from near-term drivers, which is basically how the global rate expectations are panning out. So, of course, if the view for bond market becomes that globally rates have peaked and there is an imminent slowdown which is emerging, then probably it becomes slightly negative for commodities. Dollar movement, which largely the trend has been in case the dollar is stronger, the commodities tend to be slightly weaker and vice versa. So, of course, how dollar is panning out matters. And third and very important is how China macro data is panning out, because China has been one of the biggest consumers of commodities in the last 20 years. And any slowdown in China also reflects on end-use commodity demand. So largely, to summarize, commodity-led inflation, which was a major issue between 2021 and 22, that's largely now stable. As the labor market continues to stabilize and services spending also slows down, we should probably see disinflation happening on the core side as well. And if you look at these charts or inflation in the major economies, the inflation trend has been down for a consistent period of time. If you look at, for example, the Eurozone, it's come all the way from 10.6 now below 3 as per the last reading. If you look at the Canada or the US as well, that's also sharply declining. And like we discussed in the previous slide, the whole commodity-led inflation, as well as the consumption-led inflation, which we saw, is now starting to kind of fade out. Of course, the targets for most of these central banks is 2% of for India is 4%. For most of the central banks, it is 2%, and that is the final mile. Just like in marathon is the final mile which matters about completing the marathon. This is where it also matters in inflation in for central banks, that to achieve 2%, it may require a higher economic slowdown. Hence, given that services is still in the expansionary territory, we may not see 2% inflation hitting anytime soon in absence of a major economic shock. So probably, of course, since that we are in a downtrend, the global central banks, including Federal Reserve, they may not need to hike rates more, but they may keep policy rates restrictive. And by restrictive, what we mean is that the typical when central banks use the word restrictive, they typically mean keeping real rates slightly on the higher side than normal. And by real rates, is basically means the spread over the expected inflation. So, in simple words, in case a central bank is expecting a 2.5% inflation and they want to keep a real rate of 100 basis, let's say their ideal policy rate should be somewhere close to 3.5. So, and that's how typically policy restrictions are defined. So, in case the central banks think that the ideal real rate in an economy is 100, but they're maintaining 150 basis real rate, that's how they usually term it as restrictive. If you look at this, the broad 10-year sovereign yield movement in major economies, so November was a very constructive, a month for the bond market. In fact, the U.S. aggregate bond index was about to again have a negative return this year as well, but the reversal of November 23 has in fact made it close to now, in fact, close to neutral. So that's been the trigger. So far, largely the reasons behind this major rally was one, the labor market data and inflation data was quite constructive. Secondly, one of the major concerns that the bond market has had in the last 12 months, especially coming from the US, was very high duration supply because of, again, higher fiscal than the normal for the US, and hence there was a slight amount of term premia which had built it in the US sovereign yield curve, apart from the usual expectations of future interest rates. And during the last week of October, the US Treasury announced their next year's first quarter borrowing calendar, and the borrowing calendar was in fact much better than market expectation, in terms that the duration supply that the market was envisaging was quite, in fact, the actual forecast was quite lower than what market was envisaging in the 10-year and the longer in space. So that's how the market started with a relief rally. And of course, the key commentary by Federal Reserve officials that this substantial rise in interest rates. So if you see the table in June, the 10-year US Treasury yield was somewhere close to 385, which went all the way to 493 in October. So broadly, 100 basis rise in bond yields was basically equivalent of multiple rate hikes. So what the Federal Reserve said, that probably the bond market has done the job for us, because the amount of financial tightening we were envisaging, the bond market has already incorporated it. So that was a cue that the bond market took from the Federal Reserve, that probably Fed is also slightly uncomfortable with such a large increase in bond yields, and they may look to slow down. And given since markets are forward-looking, the kind of preempted the Fed move, and we saw a rally. And of course, it was led by the US, but then all the major economies participated. Of course, the lowest one of the lowest bond yield movement was in India, because as you can see, when the US 10-year went from 384 to 493, which was a rise of more than 100 basis, or any other major economy, we can see there was a increase in bond yields by 40-50 basis points. In India, the bond yields did not rise much. In fact, in September, they were just 10 basis up and just 14 basis up in October. And that was also on the back of OMO sale announcement by the RBI. So since we did not sold off during the global bond sell-off, that's also the reason why we did not rally as much when this correction in the month of November happened. And if you look at what we were referring to the previous slide about caution from the Federal Reserve that probably the bond market is doing the job for us, or it's equivalent of a rate hike. The moment that the bond market participants got an inkling, or they kind of worked around that probably Fed will not be hiking anymore. If you look at the US Financial Conditions Index, it has come up very sharply. It was at its highest level in the year in the end of October, and it has come down sharply by the end of November. If we look at the market implied policy forecast, so this is the swap curve. This is where the bond market think that the US overnight rate will be in the month of December 2024. So if you look at where the swap curve was in the middle of or the end of October, it was close to about 480. So the bond market was just pricing in 50-60 basis points of rate cut in the next year. And you look at how it has changed; it's now gone to 4%. So there has been a major retracement of where the market was looking at the policy easing in the next calendar year. So broadly now, the bond market is pricing in a 125 basis rate cut by the end of 2024. Of course, it's just pricing, and as we know, the pricing keeps on evolving as per the economic data and forward guidance from the central bank. So in case the economic narrative changes, or the central bank deems that the financial conditions have loosened too much, what they were comfortable with, these pricing can change. But broadly, on a long-term basis, I think one thing which we can take a conclusion from is that the slowdown in economic activity is quite material compared to where we started the year at. And secondly, even from inflation, despite all these supply side shocks, the commodity prices are reflecting a weak end use demand. So in a way, that the view that can inflation go materially up from here? So probably I think it's reasonable to assume that inflation has stabilized, and probably while it may take some time to get to 2%, but the journey is very much on towards the inflation targets. Coming to India trends. So first we will be discussing the RBI monetary policy, which took place on last Friday, which was on 8th of December. And then we will be sharing other data points as well. But broadly, if we look at this policy was quite important from bond market perspective, especially with the background that we have seen the last two policies. If we recall the August policy of RBI, it had introduced ICRR, which had sucked out about 1 lakh crores of liquidity from the banking system. At that point of time, what RBI in a way had indicated that it was targeting the quantity of money. Because if you're just absorbing liquidity, irrespective of the weighted average call rate, what broadly was saying that since we are in a withdrawal of accommodation mode, we don't want to keep so much of liquidity in the banking system. But that was totally unexpected, and it led to tightening of financial conditions on the short end of the yield curve, most notably between the up to 3 months to 12 months, because that's where they usually take anchor from the overnight policy rates. Since then, liquidity had been negative, and the actual overnight rate, which was a MIBOR rate, was close to the upper end of the policy corridor, which is the MSF rate of 6.75. So despite the repo rate being at 6.5, the actual effective overnight rate for the system was close to 6.75. In the October policy, when we go, during the, in September, RBI announced that they will be reversing the ICRR. But if you look at October, so the bond market went with the expectations that since they have reversed the ICRR or the incremental cash reserve ratio, they are comfortable with reasonable liquidity and with the financial conditions. But of course, in October, RBI indicated their intention to conduct OMO or the open market bond sales to the auction route, which was a major disruption to the bond market because the bond market was not anticipating any major policy change from RBI, and that led to a reasonable amount of bond sell-off across the yield curve. So while RBI kept the policy rate unchanged in the October meeting or in the August meeting, it did affect tightening of financial conditions through its various actions on liquidity, or in case of August policy, and in terms of forward guidance if you look at the October policy. So when the bond market was approaching the December policy, there was an apprehension that probably RBI may again do some action either on forward guidance or on liquidity or on the inflation forecast that it has for the rest of the year to kind of reflect their view on the financial conditions. But the good thing was that overall the language or we look at actions from RBI in the policy, they were largely unchanged from the October policy. So whether in terms of forward guidance or in terms of language or whether in terms of inflation forecast, they were largely unchanged, and that the bond market took quite positively. If you look at the growth outlook, given the very strong growth that the Indian economy experienced in Q2, RBI assumes a certain momentum. So if we can look at the right-hand side of the chart, compared to growth expectation of 6% in Q3 FY24, now RBI expects a 6.5%. And compared to Q4 forecast of 5.7, RBI now expects a 6% growth. So basically that translates to an average real GDP growth of 7% compared to 6.5 in October 23. It even gave the forecast for the next 3 quarters of FY25, which broadly is in the range of 6.5%. But more importantly, typically when we expect a higher growth, it's reasonable to assume that if the growth is strong, even inflationary pressure could be slightly stronger than what it was before. But if you look at the inflation forecast by the RBI has kept their inflation forecast unchanged for FY24. So despite them forecasting a higher growth, they have kept the inflation forecast unchanged. And we believe that it's largely to do with how they interpret the growth. So if you look at the way where growth has really been higher than the forecast, it's largely reflective of the capex growth, especially from the government of India. And given that RBI probably is assessing the growth to be capex led, they also probably feel that it is less inflationary, because typically a capital expenditure led growth usually leads to better potential growth, and hence it is less inflationary than a consumption led growth. So if you look at the forecast for FY25 as well, it anticipates a sharp drop in Q2 of FY25 to 4% from 5.2, and then it stabilizes around 4.7%. So broadly, the second half of the calendar year is something where inflation would be close to RBI's 4% target, benefited from the base effect of the previous year, because as you can see, the actual inflation in this fiscal year in the Q2 was around 6.4%. So that's where the base effect helps next year as well. So if this is the how the inflation outlook or the inflation trajectory so far has been panning out, if we look at the right hand side of the chart, which is the diffusion index of CPI, which basically means the number of items or the weightage of items which are more than 5% inflation, that's showing a consistent fall, and it's very close to the early 2021 level. So it basically means that the rise in inflation that we have been seeing in the last quarter is largely led by one-off food price shocks, and it's not really broad-based. And that's what basically is giving RBI comfort that these shocks, once they go away, overall inflation expectations also should come down, because what ultimately the central banks are most concerned about is the second round impact of any food price shock. So in case the food price shock goes away in a short span of time, that probably does not lead to any change in inflation expectations. Also from RBI perspective, they believe that food price shocks can be better handled by supply side measures like interventions by the government, or price support by the government, like the government has done in terms of provision of free food grains to the vulnerable section of the society, whether it's selling of wheat, flour at retail outlets, whether it's banning certain vegetables to ensure that retail prices domestically remain under check. So these kind of measures are much more effective than just plain rate hike. So I think it's a combination that RBI is expecting that one, by keeping liquidity slightly tighter and keeping effective policy rates tighter, along with supply side measures by the government, inflation expectations will continue to remain anchored. So this is an update on the Rabi sowing. So like we're talking about the food price shock, so it's important to see how the sowing for at least next season is progressing. So if we look at the first chart, which is the wheat, rice, pulses, etc., all of them are slightly lower than last year. Of course, rice is materially low, but from a very low base. But if you look at pulses and wheat also, it continues to be slightly on the lower side. We will need to see how it pans out for the rest of the Rabi season to really take a call. But just looking at the sowing data may not give us true picture. So I think what we also need to look at is the amount of buffer stock that we are holding, and overall the production which is projected. And this table below, it reflects the US Department of Research demand and supply estimates for India last done in November 23. So if you look at the stock to use data, if you look at production, consumption, and closing stock, it is quite comfortable, although it's lower than what was projected in earlier in August. But nevertheless, it's better than what we were seeing in 2020-23. And the same, if you look at rice as well, production is slightly expected to be slightly lower. But overall, given the huge amount of buffer stock, the stock to use remains quite healthy. The same way we can see for cotton as well. So for the major, commodity, especially cereals like wheat and rice, the stock to use remains reasonable for now. Of course, in case the weather disruption is higher and the production further gets impacted, then these numbers may go revisions. And again, of course, and that's why we believe that RBI will continue to maintain a slightly restrictive stance, and they will want a greater confidence on the trajectory of food inflation before they take any major monetary policy action. If we look at the liquidity, we talked about the August policy and how liquidity was absorbed from the system. So if we look at the blue line or the blue part of the chart, as we can see, liquidity has been consistently negative since September, and this amber line, which basically reflects the MIBOR, if we can see, it has been largely above 6.5%, which is the policy rate, because of this tight liquidity. So this liquidity has been negative as the government has received tax collections, but there is a lag between the inflows received by the government and the time when they spend them. Till then, it basically resides outside the banking system, and hence typically any major increase in government cash balance leads to reduction in systemic liquidity. There was also the whole festival season, which started from September, and because of the high spending also there is a leakage of currency. And thirdly, RBI's FX operations. So as RBI intervenes in the FX market to manage or to keep the currency in a tighter range, it also leads to some reduction in liquidity. More importantly, RBI so far has been trying to sensitize the banks to change or to moderate the skewness in liquidity and ensure that the surplus banks are able to lend to the deficit banks within the banking system rather than RBI taking action. But what that means is, since RBI has been off hands on liquidity, which basically means that RBI has let liquidity price on its own, it means a tight liquidity as well as a rate of overnight rate, which is much higher than the policy rate, and that's led to repricing of the money market curve as well. The other reason for the repricing of money market curve is also, if you can see this chart, it basically signifies the non-food credit growth compared to deposit growth. And as we can see, the gap between credit growth as well as deposit growth continues to be high. So we continue to expect a reasonable amount of credit growth in the system, at least in the next 3 to 6 months as well. And given in case banks continue to see high credit growth, it also means that there will be a pressure to raise deposits even at slightly higher levels to meet the credit demands of the economy, which basically means for the bond market that the short-end rates could continue to remain elevated. They may not go up materially, but they may continue to be slightly elevated. If we look at the fiscal trend for the central government, overall, the tax collections have been very healthy. If you look at direct tax collections, they have been 17% versus 11% budgeted. But if you look at income tax, in fact, it's 31% compared to 11% budgeted. And if you look at, on the expenditure side, central capex continues to be very strong and led by roads, railways, and defense. Broadly, we don't see any risk to FY24 fiscal deficit materially because while there is a shortfall in the disinvestment, there is also higher subsidies on food because of free food grain programs and fertilizer subsidy. Nevertheless, the higher tax collections and higher dividends from RBI as well as PSUs will offset some of these, extra expenditures. So broadly, we don't really see any risk to fiscal deficit. Coming onto the external account side, the increase in trade deficit from approximately 20 billion to 31 billion in October 23 was quite material, but we believe that it was an anomaly because of seasonal demands, as the Diwali was in November, and probably it should correct. So if you look at gold imports, for example, they were way above the usual trend that we have been seeing. So from 4.1, they stayed away jump to 7.2, and even in non-oil imports, it was quite significant, probably because of the festival season. So we need to see how these imports evolve to really take a sense. But as of now, we think that probably this should revert back to the old trend once the festival season fades out. In a nutshell, if you see on how the rates have moved, and like I was saying, that because of high credit growth as well as tight liquidity, there was a correction on the money market curve, which is also reflecting on the 1 year, 3 year rates, for example. So if you look at AAA, rates compared to October 23, there was a upward movement across the curve, whether you look at 1 year, 3 year, or even 10 year AAA. those rates have gone up because of this repricing, or you can say changes in overnight rate as well as tight liquidity. But if you look at the GSEC curve, the GSEC curve in fact has rallied. If you look at, for example, 3-year GSEC, 5-year GSEC, or 10-year GSEC, that has done better as globally conditions became more benign for fixed income, and overall view on duration became more constructive. So largely, what is the outlook, from us and the recommended products? So largely, in the last, so like we were saying, that as the economic momentum has slowed down, as inflation has become stabilized, earlier the question the bond market was grappling was that how many more rate hikes. Now the debate has shifted from how high the rate should be to how long to keep rates high enough. So like I said, now central banks are waiting for hard evidence that inflation is indeed slowing down, and inflation is slowing down close enough to their targets for them to ease monetary policy. But now the question no more is that whether they need to hike rates more. I think there's a large consensus in the financial markets as well as the central banks that probably, while it's premature to talk of rate cuts, but probably inflation as well as interest rates have peaked in this interest rate cycle. So like I said, probably that view on monetary policy easing we can expect in the latter part of this calendar year 2024, because given that we have seen very, very high inflation post the COVID reopening, central banks will want to be fully confident as much as they can be before they start on the reversal of all the tightening that they did in 2021-22. But specifically for India, we do not expect a major rate cut cycle. We expect a shallow rate cut cycle, which is basically between 50 to 75 basis. The reason being that growth for us remains quite resilient despite a global slowdown. And more importantly, inflation may not sustainably remain at 4%, while we may see a couple of quarters or maybe that inflation goes at 4%, but largely while food inflation is expected to come down because of once these shocks go away, but core inflation can also go up from these very low levels once economy continues to grow at these kind of rates. So probably the kind of slowdown or the kind of disinflation that we will see globally, we may not see that in India, and hence we expect a shallow rate cut cycle. So what really makes sense in this cycle, see, if you look at on the yield curve, for example, a 3-year AAA today is yielding around 787. If you look at a 1-year as well, 1 year is yielding around 780. Given that the view has now moved to that probably we have reached peak of policy rates and the next step is likely to be a cut rather than a rate hike, we believe that investors are getting very reasonable level of yields with a possibility of participating in capital gain as the interest rate cycle turns. So even if an investor has a 6 to 12 months horizon and they can consider low duration or money market strategies, probably even if they don't see any major rate cut led rally during that time, the accrual on these kind of strategies is also quite handsome. And if an investor has some appetite for intermittent mark-to-market volatility and more than 12 months investment horizon, they can consider strategies like corporate bond, short-term or banking PSU, basically moderate duration categories, which also give them reasonable accrual as well as possibility of participating capital gains. Mind you that markets work on forward pricing mechanism. They don't wait for the actual rate cut sometimes for changes in bond yields. Largely, they try to predict how interest rate cycle is likely to pan out and move accordingly. So probably in the latter part of CY24, when the bond market has a greater confidence on central bank policy easing, that is when probably we may see some re-rating in the bond yields as well. So that's why we are recommending that investors who can tolerate some mark-to-market volatility but have more than 12 months at investment horizon can consider these moderate duration categories. So that was it from us. Thanks a lot for listening in. Happy to take up any questions.
Thank you, Anurag, for taking our listeners to the and the viewers on the fixed income market updates and sharing your outlook over there. Moving on to the questions. The first question here is how bond yields in US rallied upon lower bond supply from Fed.
So like we were discussing, so there was a concern amongst market participants that in a period where the Federal Reserve is shrinking its balance sheet, at the same time the US government is expanding its deficit, ultimately supply has to meet demand somewhere, and probably when the supply gets higher than demand, the price gets lower. I mean, it's a simple equilibrium, and the equilibrium was trending higher in terms of bond yields. So when the US Treasury announced the borrowing calendar for the next quarter, and they announced a lower than what was envisaged by the bond market, bond yields rallied because of that, because it was also a reflection of the recognition that the US Treasury was making to the bond market that yes, we understand that these amount of supply is unsustainable, and it also reflected their discomfort with the yield, because if the government continues to borrow at that yield, that also means that they're comfortable with a certain high level. So that the fact that they decided to reduce their borrowing also reflected that they probably will not be happy to borrow at these yields. So that's also the cues that the bond market took, and that's when the correction in bond yields happened.
Sure. So the next question is, the odds of rate cut in March are now high, close to 63%, with the odds of aggregate rate cuts of somewhere 125 bips in 2024, also above 50% for US. So what are your views on the rate cuts by the RBI in 2024 and the next year?
So like we said, that probably it will be a shallow rate cut cycle. US, if you look at the average interest rate in the last 15-20 years, and if you compare the current interest rate in the US to that, it's significantly higher than the trend interest rate than what US is used to. If you look at India interest rate, we are at 6.5, which is not very different or not very high compared to the trend level of policy rate that India has seen. So probably the scope for cutting rates in India is slightly lower than what we see in the US or the other advanced economies. So our view is probably a 50 to 75 basis points of rate cut, barring a major economic shock.
Sure. So are we trying to say like India has decoupled from the other economies like US?
So decoupled is a wider term. I wouldn't say that. So we are recognizing that India will also go for monetary policy easing. So it's not really decoupled, because it will cut interest rates. It is expected to cut interest rates when other central banks are also cutting interest rates. Only the magnitude is different.
Sure. So the next question is, RBI has not yet changed the stance despite improved growth and core inflation around 4%. Does this mean the rate cut is not going to happen anytime soon? While you have covered this a bit, still this is the queries from the
RBI has clarified that their target is headline inflation and not just core inflation. So they would want these one-off food price shocks to go away. And inflation, they would like to see inflation stabilize, and then probably they will go for rate cuts. So that's why we do expect that RBI may be in a position to act in the second half of the calendar year once they see that all those food price shocks have gone away.
So So the next question is again related to the monetary policy and the RBI views. In the October policy, RBI has indicated the probability of OMO sales to manage liquidity. Since in this policy, the concern of OMO by the RBI is fading somewhat, do you think the yields have now peaked out? Can investors look into adding duration to their portfolios? Or are there any other factors that they should consider, while managing duration of their portfolio?
Right. So I would say inflation and inflation expectations have largely peaked out. In the near term, bond yields may still remain volatile because like I said, you are still in a zone where central banks and even the financial markets are making up their mind at how whether inflation can really come down close to the target levels. So till then, there could be near-term volatility. So while we believe that in 6 to 12 months' time, this inflation will come down and it will open up space for rate cuts and some rally in bond yields. But in the near term, bond yields may remain volatile. So for investors who are tolerant with some amount of volatility, only they should consider investing in duration funds. And secondly, their time horizon has to be more than 12 months.
Sure. So what should be your advice to the investors who are the first time investors or early investors into mutual funds and now exploring the debt funds? So what would be your advice to such investors?
This has always been consistent that for investors, irrespective whether they are beginners or they have been in the mutual fund for a long time, when an investor looks at fixed income mutual fund, they are looking for stability and predictability. And hence, the portfolios they should consider should also reflect those values. So investors who are looking at fixed income either are looking for liquidity or some stable, predictable returns. So then they may divide their portfolios into liquid, which is basically 5 to 10% of their fixed income allocation, which could be an overnight or a liquid fund. The rest, 60 to 80%, let's say they should invest in moderate duration categories, which is less volatile than very long duration categories and which focus on a reasonable accrual as well. So where the volatility on both sides is moderate, and hence we recommend 60 to 80% of allocation into short-term corporate bond kind of moderate duration products. And for the last 10-20%, they probably can invest as a disciplined asset allocation into for investors who are okay with duration risk into gilt funds, or investors who are comfortable with credit risk into credit risk funds. That should be the ideal asset allocation that we would recommend.
Sure. Since we are discussing asset allocation, so while the tax advantage which debt mutual funds had was gone, in the current financial bill. However, the investors keep arguing why should we consider investing into fixed income funds, especially at the shorter end of the curve, when term deposits have been offering better fixed interest rates. So
right.
Yeah. So why should investors consider investing into debt funds? Why they cannot afford to ignore debt funds?
Right. So that's a very valid question that why should they consider mutual funds over other traditional fixed income instruments when there is no tax benefit? So like we were, talking about in the previous question. So one benefit or one reason why investors look at debt funds is stability of returns. I think the second but overlooked factor when we do asset allocation is liquidity as well. So mutual funds, they also offer decent liquidity. That is, the funds which do not have an exit load or do not have a very high exit load, they do offer liquidity to investors and which are probably not present in all other traditional fixed income instruments. So that's, I would say, one benefit. So let's say even if somebody has invested with a 1 year or a 6-month horizon in mind, and they want to, let's say, they are in need of funds after 3 months, they can do relatively at a more cheaper cost in a mutual fund than any other traditional fixed income instrument. Secondly, many fixed income instruments do not participate in interest rate cycle. Since mutual funds are daily mark to market, they also reflect market yield expectations much better. And hence, in case an investor has a view, that probably rate cycle has peaked and in the next 12 months, rates could come down. Mutual funds, I would say, can be quite efficient in transmitting those capital gains and when the interest rate cycle turns. So both in terms of participation in the bond market as well as in terms of liquidity, mutual funds can offer those benefits.
Very well said. So moving on to the next question. It's related to the risk weight changes done by the RBI on the NBFCs. Since the RBI has increased risk weight on loans by NBFCs, this has increased the cost of borrowing for these entities. How do you see movement of short-term rates due to this into the segment?
So so there are two parts to I think this measure as far as the bond market or the money market for such sector is concerned. One is the cost of fund really changes for many of these NBFCs if they continue to grow at a historical pace. So if they slow down their pace, the cost does not materially change for them. The second, if they pass on the cost to the customer, their profitability does not get impacted materially. So so on both the things. So let's say if NBFC feels that probably they will not be able to pass on the cost to the customer, then that's an issue of growth rather than just credit quality. From a bond market perspective, it also slightly changes the perception of the sector, because at least in the very, very near term, because there is a slight concern that maybe RBI thinks that the growth is too fast for some NBFCs. So I will not want to paint the whole sector with the same brush, but probably some pockets of NBFCs where the unsecured lending is quite high, because mind you, RBI has only increased weightages in unsecured lendings, and even within unsecured, they have left out some high growth areas. So I think from a fixed income standpoint, it's a very, very positive step, because one, it moderates the growth of those NBFCs. So the growth becomes much more stable, because mind you, we are focusing on capital preservation of our investments. So for us, anything which increases the capital buffer, is positive for us, and anything which moderates the very, very high growth is positive for us. So I would say it's good from fixed income standpoint. Of course, some weaker NBFCs may not be in a very strong position after the measures, because they will have to curtail their growth quite meaningfully, and probably it will lead to concern in the bond market. So bond spreads for NBFCs compared to similar maturity, other AAA or let's say other similar rated bonds may go up. So basically, portfolios with lower NBFC exposure in the near term may do better than portfolios with high NBFC exposure.
Sure. I guess our viewers are very much interested into US markets. A couple of questions that I have lined up are based on US markets. So US labor market unexpectedly strengthened in November with pickups in employment and wages. You had covered a bit of this while you were discussing the outlook part. Non-farm payrolls also increased last month. So what, according to you, would be the Fed's move in the upcoming meet?
So I think as far as the non-farm payrolls are concerned, that's quite a volatile data. If we see in the last 6 months, there have been very large revisions next month on the previous month data as well. So we'll need to see the trend, whether this is a one-off number in the on the payroll side, or whether this is a major trend. From an overall, I think bond investment or a bond market standpoint, I think it's at least the bond market is going with the expectation that it will be a status quo policy as far as the Fed is concerned. Fed does release its dot plot and its economic projections in the policy. So the bond market will be watching that how the Fed is assessing the nature of inflation in 2024 from the dot plots as well as the economic projections. But even the Chairman Powell had said previously that those dot plots don't have that much value because they get stale very fast. So given the rapidly changing nature of the economy, I will not give one meeting too much emphasis.
Sure. So like you mentioned that we are expecting a shallow rate cut cycle in India.
Right.
And going by that, if there will be more rate cuts in the US than in India, does it make sense to invest into long-term US bonds, considering the rupee dollar rate also?
Sorry, which bonds?
Long-term US bonds.
Long-term US bonds. So that's an individual's, as per individual risk appetite. I would just like to add that why an investor may choose to invest in such products. However, one also has to consider the amount of volatility that the US bond market has exhibited, especially in the last couple of years. So the volatility in the market has been very, very high, compared to the usual trend that we have seen in the US bond market because of this, on and off false starts on inflation as well as on labor market. So as long as the investor is extremely comfortable with unusually high volatility and is patient with probably investment horizon of 2-3 years, probably they may consider investing in such bonds, but one has to be prepared for a very high volatility on a regular basis in their portfolio.
Sure. Thanks for that. At this time, I would like to mention to our viewers that you are given a feedback link on that. So please do share your feedback before you log out. And considering the paucity of time, we will take a couple of more questions, maybe 2 to 3 questions more. So moving on to the next question. What does the global setup suggest about FII flows in Indian debt market? How do we stack against peers when it comes to our fixed income valuations?
So far, if you see, India was not really on the radar of global bond investors because of certain operational challenges in terms of registration, in terms of taxation, and in terms of compliances, as far as comparison with some of the other EMs are concerned. But our policymakers have been quite clear that they do not want to differentiate between domestic investors and global investors, and so they do not want to attract any hot money, which may lead to medium to long-term financial instability. So the bond investors so far were not really, I would say, present too much in India compared to their share, let's say, in some of the other emerging markets like Indonesia, Malaysia, Vietnam, etc. Having said that, with the inclusion of India into JP Morgan Global Emerging Market Bond Index, the interest in India is increasing. And given that the index tracks about $270 odd billion of assets under management, we may see inflows about 20 to 25 billion in total up to the final date of index inclusion, which is March 2025. So that is positive. But of course, like I said, India, so far, the government of India policy has been to discourage hot money, and which can lead to instability on the currency as well. So probably I would say that India would probably welcome, index-related or policy-related flows rather than just investors chasing on yield differential. So I think we should continue to see interest, but largely on index-related or specific structures-related flows.
Sure. Next question, moving on to Chinese data, continue to hurt sentiments. How should one read these indicators?
So, like I said, I mean, in the call as well, so China is undergoing some restructuring where their real estate sector, which is the biggest part of the GDP, is undergoing some weakness. The policymakers are loosening various measures to encourage more real estate activity. I think we will need to see evidence of a change probably, but that change may take 12 or 18 months to pan out. So probably it's a more of a long-winded, I would say, consolidation, and then probably China, we could see some potential stabilization there. But for now, I think, like we discussed, I mean, despite all the supply side shocks, the fact that commodity indices are range bound and have not really gone up does reflect the end user demand, which is not based on expectation, but actual, support, actual demand is still quite low. So I think that's reflective of the actual, weak growth which the Chinese economy is experiencing.
Sure. So my next question is not really the question, but seeking your views for the viewers. Since this is our last webinar for this calendar year, so what is your advice and suggestions to the investors? And with that, we may then conclude the webinar.
So, given that investors may be looking at their next year's allocation, largely the view is that, of course, in the last 2 years, interest rates as well as inflation has been quite volatile. But mind you, they were coming on the back of a very, very large economic shock, which was the pandemic. It was coming on the back of a huge fiscal and unprecedented monetary support, which the global economy saw. And of course, as we exited all of that, there was a disruption that we saw in the bond market. But largely, that disruption seems to be behind us. Whether you look at inflation, you look at the monetary policy, look at the fiscal policy, they seem to be reverting back to trend. So while it's too early to say that whether we are in a structurally low inflation or a structurally high inflation world, but largely we can say that interest rates 12 months from now or in 6 to 12 months should be lower than what they are right now. And given the correction which has happened on the bond yields today, you really don't need rate cuts to earn reasonable carry or accrual in your bond portfolios or your money market portfolios. Today, a AAA, whether a money market product or a corporate bond product, is giving you yield between 770 to 790, which is quite attractive given that we have largely seen the peak of inflation. So we believe that investors, as per the time horizons, should choose their investment vehicle. But largely, we do recommend that investors should not be holding on to too much cash, and they should start to invest if they don't want too much volatility. Probably they can stagger their investments the next 3-4 months. But we do advise that right now, the last 2 years, the motto has been the cash has been one of the best performer in the fixed income asset class. Probably in the next 1 or 2 years, we will see other products also doing much better than cash. So that's, I think, what the takeaway I would leave in this session.
Thank you, Anurag, and thank you, viewers, for watching this video. Please stay tuned. We do come up with our webinars every month. We'll keep you posted on the next date for the webinar, and do share your feedback. Thank you.
Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.